15% up, then 15% down, same asset, same week. That's not volatility. That's a pricing mechanism discovering it no longer knows what it's pricing. On April 9th, silver futures gapped higher in Asian trading by a margin that triggers automatic risk reviews at every major clearinghouse. 48 hours later, they gapped lower by nearly the same amount. Two moves of that magnitude in opposite directions don't cancel out. They compound. Because what they reveal is that the range of possible prices has become so wide that the concept of a fair price has temporarily stopped functioning. The headline explanation is tariffs. Trump announced, reversed, clarified, then re-announced export restrictions affecting Chinese metal processors. Markets reacted. Case closed. That explanation satisfies a news cycle. It doesn't satisfy a balance sheet. Because what actually moved silver wasn't the tariff. It was a very specific calculation about 44 Chinese exporters and whether the physical metal they process can still reach Western vaults at a predictable cost. Hold that number, 44. We'll come back to it. The surface story is trade war noise. The mechanical story is that silver's paper price briefly attempted to reflect physical reality, found the gap uncomfortable, and retreated. That retreat isn't resolution, it's deferral. And what got deferred is now sitting on a risk register at every institution with exposure to precious metals settlement. Here's what I'm going to walk you through. First, why silver's price behavior no longer reflects silver's supply and demand in any traditional sense. Second, what 44 Chinese exporters have to do with the marginal ton of refined silver reaching Western vaults. Third, how a tariff reversal that was supposed to calm markets actually revealed the precise vulnerability that institutional players have been quietly positioning around for the past 18 months. And fourth, what happens next if the current trajectory holds. This isn't speculation, this is mechanics. Let me explain how silver actually moves from the ground into your portfolio, because this is where most analysis fails before it even starts. When you buy silver through an ETF or a futures contract, or even a dealer, you're not buying silver, you're buying a claim on silver. That claim has value only if, at the end of the chain, someone can actually deliver refined metal to a vault that your claim references. The entire system works because no one ever actually demands delivery at scale. Everyone assumes that if they wanted delivery, they could get it. That assumption is the foundation. It's also the single point of failure. Think of it like a hotel with 1,000 rooms that has sold confirmations to 10,000 guests, knowing that historically, only 800 ever show up on any given night. The system works beautifully until 950 show up. Then the math fails, and everyone standing in the lobby realizes simultaneously that their confirmation does not mean what they thought it meant. In silver, the outstanding paper claims on physical metal now exceed the deliverable inventory by a ratio that, if I told you the number directly, would sound like I was exaggerating, so I'll let you find it yourself. Look up registered COMEX inventory. Then look up total open interest in futures and ETF shares. Do the division. That number is the hotel's overbooking ratio. And that ratio is why a 15% move in both directions within a week is not noise, it's signal. Now, here's where China's 44 exporters enter the picture, and this is where it gets uncomfortable. Approximately 71% of the world's refined silver passes through Chinese processing at some point in its journey from ore to deliverable bar. Not production, processing. China doesn't mine 71% of the silver. China refines it. This distinction matters enormously because it means the physical bottleneck isn't in the ground. It's in the middle of the supply chain. And that bottleneck has a name. It's called toll refining. Chinese refiners take concentrate from mines in Mexico, Peru, Australia, and process it into the 999 fine bars that Western exchanges accept for delivery. The 44 exporters on that list aren't silver miners. They're the refiners, smelters, and traders who handle the conversion from raw material to deliverable product. When tariff policy creates uncertainty about whether refined silver from those 44 entities can enter the United States without a 34 to 145% surcharge, the market doesn't just price in a tariff. It prices in the possibility that the conversion pathway itself becomes unreliable. This is the calculation that broke on April 9th. Here's how it works in normal times. A refiner in Hunan takes concentrate from a Mexican mine. Processing takes roughly 6 to 8 weeks. The resulting bars are shipped to a bonded warehouse in Rotterdam or Singapore. From there, they're allocated against futures contracts or ETF baskets based on price and logistics. The whole system assumes continuous flow. Inventory is thin because flow is reliable. No one stockpiles what they can order on demand. Now introduce tariff uncertainty at the 44 exporter level. Not a tariff, uncertainty about a tariff. Suddenly, no one knows whether metal processed through those entities will clear U.S. customs at 0%, 34%, or 145%. The spread between those outcomes is so wide that no rational trader can price for delivery. So they don't. They pull bids, they widen spreads, they wait. That's not a supply disruption. That's a pricing disruption. But in a market where inventory is thin and paper claims are high, a pricing disruption becomes a supply disruption within 72 hours. Because if you can't price delivery, you can't offer delivery. And if no one offers delivery, the paper claims start trading against each other with no anchor to physical reality. This is where the April 9th gap came from. Not panic buying. Mechanical repricing of what it would cost to source non-Chinese refined silver for guaranteed delivery. That metal exists. It's just more expensive, slower to source, and insufficient in quantity to meet total outstanding claims. The 15% gap was the market discovering, in real time, the premium required to guarantee physical settlement outside the Chinese processing chain. Hold that framework, because the reversal on April 11th is where it gets more interesting. Trump's partial tariff pause was announced as a de-escalation. Markets were supposed to calm, and on the surface, they did. Silver dropped nearly as fast as it had risen. The headline read, "Crisis averted, volatility subsiding, normal service resuming." But look at what actually happened in the plumbing. The tariff pause didn't eliminate the 44 exporter list. It deferred decisions on specific product categories. Silver wasn't explicitly exempted, neither was it explicitly included. The pause created a 90-day window of continued ambiguity. And here's the critical point. The 15% down move wasn't relief. It was the unwinding of speculative longs who had bet on the breakout and got stopped out when the immediate crisis narrative dissolved. But the physical market didn't reverse. Premiums for delivered metal in London and Singapore remained elevated. Lease rates, the cost to borrow physical silver, stayed at levels not seen since 2020. The paper price collapsed. The physical tightness didn't. That divergence is the signal. And that signal says the system briefly revealed its vulnerability, then returned to pretending the vulnerability doesn't exist. This is how markets behave in the late stages of a confidence regime. The paper price becomes a consensus fiction that everyone agrees to maintain because the alternative, discovering the true clearing price for physical delivery, would require losses that no one's balance sheet can absorb. Let me walk you through the internal calculation that risk desks are running right now, because this is where probability meets consequence. Start with baseline. COMEX registered silver inventory sits at approximately 28 million ounces. That sounds like a lot until you realize that a single large ETF holds claims on more than that. Total deliverable silver in LBMA vaults, the London system, runs around 800 million ounces on paper. But when you net out what's already allocated, what's held for industrial users, and what's in transit, the genuinely available float is closer to 120 million ounces. Now run the stress scenario. If tariff ambiguity causes just 15% of Chinese refining throughput to pause or reroute, that removes roughly 400,000 ounces per week from the delivery pipeline. At current inventory levels, the buffer lasts approximately 8 weeks before physical settlement failures begin. But here's where the math stops working. Physical settlement failures don't happen gradually. They happen all at once. Because the moment one counterparty fails to deliver, every other counterparty with exposure to that chain immediately demands their own delivery. It's a bank run, except instead of cash, everyone's demanding metal. And unlike cash, metal can't be printed. The assumption that broke in April was simple. Everyone assumed that tariff policy would remain stable enough to permit continuous flow through Chinese processors. That assumption no longer clears, not because tariffs were imposed, but because the credibility of any tariff regime has degraded to the point where 6-month forward planning is no longer possible. This is the chokehold. 44 exporters control the conversion of raw silver into deliverable product. Tariff policy controls whether that product can enter the Western financial system at a predictable cost. When tariff policy becomes unpredictable on a week-to-week basis, the entire pricing mechanism for silver, which depends on arbitrage between physical and paper markets, loses its anchor. Stay with me, because this is where the second-order effects begin. When physical premiums diverge from paper prices, the first response is arbitrage. Traders buy paper, sell physical, and pocket the spread. This works as long as they can source physical to deliver against their sales. But when physical availability tightens, the arbitrage reverses. Now, traders are short physical in a market where physical is scarce. Their only options are cover at any price or fail to deliver. The covering creates a squeeze. The failures create contagion. And the contagion doesn't stay in silver. It spreads to gold, to copper, to every metal where the same processing choke points exist. Because here's what most people don't realize. Silver isn't unique. The same 44 exporter list affects rare earths, refined copper, battery-grade lithium, and half a dozen other metals critical to electronics, energy, and defense. Silver is simply where the math breaks first, because silver has the highest paper-to-physical ratio, the thinnest deliverable inventory, and the most fragmented oversight. It's the canary. And the canary just gasped twice in 1 week. And let me describe what I call split reality, because this is the phase we're entering now. In one reality, the paper price of silver reflects a functioning market where supply and demand clear through continuous exchange. That reality produces a price around $32 per ounce, give or take a few dollars depending on the week. In the other reality, the physical price of silver reflects what it actually costs to obtain refined metal for industrial use or guaranteed delivery. That reality produces a price somewhere between $36 and $44 per ounce, depending on quantity, purity, and delivery timeline. These two realities have been coexisting for approximately 3 years now. The gap between them has widened slowly, then quickly. April's volatility was the system briefly acknowledging the gap, then retreating back into denial. Here's why convergence is unavoidable. The paper market is a claim on the physical market. If the physical market can't deliver against paper claims, the paper price loses meaning. It becomes a derivative of a derivative, unmoored from the thing it supposedly represents. At some point, and no one knows exactly, when enough participants demand physical delivery simultaneously that the paper price must reprice to reflect actual availability. That repricing is not gradual, it's discontinuous. I'm going to give you 3 outcomes now. One is impossible, one is disorderly, one is managed. I'll tell you which one we're currently tracking toward. Outcome 1, the paper and physical markets reconverge smoothly through gradual price discovery. This requires tariff policy to stabilize, Chinese processing to continue uninterrupted, and no major industrial consumer to demand delivery at scale. The probability of all 3 conditions holding simultaneously for the next 18 months is functionally 0. This outcome is impossible. Outcome 2. The paper market reprices violently to reflect physical scarcity. This produces a gap move similar to April's, except it doesn't reverse. Paper silver goes to 50, then 70, then the exchange declares a settlement emergency and forces cash settlement at a fixed price. Holders of paper, claims receive dollars instead of metal. The physical market continues trading at a premium to whatever the cash settlement price was. This is the disorderly outcome. It has approximately a 25% probability over the next 2 years. Outcome 3, the paper market slowly loses relevance as physical transactions migrate to bilateral contracts, private vaults, and sovereign reserves. The headline paper price stagnates while the real price, the price for actual metal, drifts steadily higher in unreported transactions. This is the managed outcome. It allows institutions to reposition without triggering a crisis. It protects balance sheets at the cost of transparency. It's the path of least resistance, and it's the current trajectory. Probability, approximately 60%. The remaining 15% is distributed across scenarios I can't model. Geopolitical escalation, exchange rule changes, or a central bank intervention that breaks the framework entirely. Here's what this means if you're watching this. If you hold paper silver through an ETF or a futures contract, you hold a claim that may or may not convert to metal at par when you want it to. The system is designed to discourage delivery requests. It works because almost no one requests delivery. The moment that changes, the system reprices. If you hold physical silver, you hold something whose paper-denominated price may not reflect its actual exchange value. You're outside the paper system. That's protective in a crisis and irrelevant in normal times. The question is which period we're in. If you hold neither, you're observing a market that is telling you something important about the reliability of price signals in complex supply chains. Silver isn't just silver. It's a proxy for every physical commodity that flows through concentrated processing choke points and trades on leveraged paper markets. Here are the indicators to watch, not to panic over, to monitor. First, the spread between spot silver and 1-month futures. When this spread goes negative, meaning futures trade below spot, it indicates that immediate delivery commands a premium over promised future delivery. That's backwardation. It shouldn't persist in a functioning market. When it does, the physical market is signaling that promises have become less reliable than possession. Second, COMEX registered inventory levels. Below 20 million ounces triggers a different risk calculus for every major holder. We're at 28 now. The trend matters more than the level. Third, LBMA lease rates. These are the rates at which physical silver can be borrowed in London. Normal rates are negligible. Rates above 1% annually signal tightness. Rates above 3% signal stress. Watch for sustained elevation, not spikes. Fourth, Shanghai-London price arbitrage. When Shanghai silver trades at a significant premium to London, it indicates that metal is flowing east rather than west. That flow direction tells you where the real demand is and who's willing to pay for guaranteed delivery. Fifth, tariff policy announcements. Not the announcements themselves, the frequency of reversals and clarifications. Policy volatility is the transmission mechanism for physical market stress. The more volatile the policy, the wider the uncertainty band, the less reliable the supply chain. Let me zoom out now, because silver isn't the story, silver is the symptom. For 40 years, global trade has operated on an assumption. that goods, commodities, and components flow across borders with predictable costs and timelines. That assumption permitted just-in-time supply chains, minimal inventory buffers, and maximum capital efficiency. It also created dependencies so deep and so distributed that no single actor fully understands them. China's 44 exporters aren't the choke point because China planned it that way. They're the choke point because the entire global system optimized for efficiency rather than resilience. When you optimize for efficiency, you concentrate processing. When you concentrate processing, you create single points of failure. When you create single points of failure, you hope nothing disrupts them. Tariff policy is now disrupting them. Not through actual tariffs, through the threat of tariffs, through uncertainty, through the inability to plan 6 months forward with any confidence. And that uncertainty is propagating through every supply chain that touches Chinese processing, which is to say, almost all of them. Silver is simply where the math breaks first. It won't be where it breaks last. The question is not if the gap between paper claims and physical reality closes. Gaps always close. The question is whether they close gradually, through managed repricing and quiet institutional repositioning, or suddenly, through forced settlement and public acknowledgement of what the system has been pretending isn't true. The April moves told you the answer is closer than most people think. Not because the moves were large, but because they reversed. A 15% gap that sticks is a new price. A 15% gap that reverses is a system desperately trying to return to an equilibrium it can no longer sustain. The equilibrium is pretense. The pretense is eroding, and 44 exporters just showed you exactly where the erosion will appear when it finally becomes impossible to ignore. The question is not if, the question is how long.